Hi, in this video, I will show you how to answer this November 05 paper 2 question 6, and after that you should do these questions on your own. Okay, so you look at this question. The following profit and loss account has been prepared using absorption costing principle. Okay, in lesson 6 part 1, I have explained to you that we will find out the overhead absorption rate, and then every regular basis, probably every month when we do our profit and loss account, um, we will we will estimate the we will estimate the production overheads, the production overheads, this one is production overhead, by 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 taking the overhead absorption rate times by the, for example, the actual machine hours, if it's absorbed on the basis of machine hours. So this overhead, the production overhead over here in all the monthly profit and loss account, in all the monthly profit and loss account, we will obtain this production overhead by taking our overhead absorption rate times by the actual machine hours as production progresses. Then at the end of the year, we will find out the actual production overhead, and then we compare it with the total production overhead absorbed, and then the difference would be the production overhead over or under absorbed, and this production overhead over and under absorbed will be will be adjusted. This is adjusted as aligned in the profit and loss account. So this is the adjustment. So this production overhead over here, this is the production overhead absorbed, for this entire year. This is the production overhead absorbed for this entire year, and this is the adjustment for the production overhead, in order for this one, say, minus this one because it's over absorbed, minus this one will be equal to the actual production overhead, which is calculated at the end of the year. So now we understand what is this. And then I have also said that financial accounting means the accounts that we need to prepare to satisfy the government requirement, for example, to file for tax and to submit to the government. Okay, that is financial accounting, which is what we must do. So this profit and loss account over here is actually a profit and loss account in a financial accounting format. It is prepared using the absorption costing principles. Okay. Then we also said that management account are accounts that we will prepare just for internal purpose, for us to manage our business better. It is the government does not want to see our management account, but the government would want to see our financial accounts, which is in this format for the profit and loss account. Okay, the directors are concerned about how much lower profit in 2005 and ask you to investigate the causes. You ascertain the following information. Okay, so before we read so much detail, can we see what the question is asking? What the question is asking. So question, you should have your question paper in front of you. Okay, the question says, A, present the profit and loss account for 2004 and 2005 in a marginal costing format. So this is in this financial accounting, or for this profit and loss account, is in the absorption costing format. Okay, so, and this is for the purpose of satisfying government regulation, for example, for submitting tax, for submitting to the government. Okay, but if you want to prepare a profit and loss account in marginal costing format, this is for internal purpose, to show our boss, so that our boss and the management of the company can make a better decision, can help, so that so that the management can make a better decision for the company, you know. Okay, so what is this? Prepare the profit and loss account in a marginal costing format. Okay, you see, this is a profit and loss account in the absorption costing format. In the absorption costing format, we do not segregate fixed costs and variable costs. But if you want to do the, okay, so without thinking too much, so I have to present a profit and loss account for 2004 and 2005. Okay, since the figures are very big and here is in thousand, I will decide that I would want to put the figures in thousands. Okay, profit and loss account, year ended 30 September 2004, 2005. So I get my structure ready so that I will put myself ready to get started. So I have to present this profit and loss account in a marginal costing format. Okay, so that means marginal costing format, you will have a turnover less. Okay, this is the fundamental format for marginal costing format. So you have turnover, then you less variable cost, you underline. Okay, then you can leave a lot of space. You can leave about half a page, you know, half a page. Just leave half a page first, and then less fixed cost. So that means the fundamental format for a marginal costing format for profit and loss account is turnover, less variable cost, underline, leave half a page, then less fixed cost, underline. Okay. So turnover less variable cost, you will get contribution. Okay, turnover less variable cost, you will get contribution, and then less fixed cost, then you will get net profit. So you can lay out your whole page. You can lay out your whole page. Turnover, then less variable cost, leave about 2/3 of the page. Then you put your contribution, then less fixed cost, then at the end of the page will be net profit. Okay, so we have started. So turnover figure we will copy from here. Turnover figure is given 840 and 630. 840 and 630. Okay, then after that, under variable cost, you see, variable cost, you see, in a company, you will have an office and you will have a factory. You will have an office and you will have a factory. And in the office, you will have fixed costs and variable costs in the office. In the factory, also you will have fixed costs and variable costs. So this variable cost, we have variable production cost, meaning variable factory costs, right? Okay, variable cost, factory costs. So these are my variable factory costs. Then I have to add variable so-called office costs. So these are variable selling expenses is actually the variable cost, but it's the variable cost in the office. Okay. Now I explain again. In a company, you will have an office and you will have a factory, right? In the office, you will have fixed costs and you will have variable costs. And in the factory also you will have fixed costs and you will have variable costs. So this variable cost is the variable cost for the office and factory. Right. Okay, so then now under this variable cost, we put your variable production cost. In other words, this is the variable factory cost, right? This is the variable factory cost. Then I leave some space. Then after that, I add ... I don't put here anything here first, but I mean that I'm supposed to write all my variable office costs here. Variable selling cost is variable office cost, right? So I put add ... then I leave it first. Then I can leave one line. Then I put total variable cost, right? Okay. So that means the turnover minus all the total variable costs, I will get my contribution. Then same thing, fixed cost, you will have the office fixed cost, you know, fixed selling expenses and admin expenses are office fixed costs. And you will have the factory fixed cost, you know, fixed production overhead is the factory fixed cost. So now you have it clear. Right. Okay, so now we look over here. Okay, in this profit and loss account prepared using absorption costing basis, we don't segregate fixed costs and variable costs. It seems over here, it looks to me, except this line, you see the turnover minus all this direct material, all this appears to be the factory cost. This 480 appears to be a factory cost. And except this one, this one is adjustment for this production overhead. Below here it seems to be all the office costs. So now we can imagine that absorption costing principle for profit and loss account separates between between factory costs. On top here is factory costs, and below here is office costs, except for production overhead. Then we get net profit. So that means you can see the pattern, like turnover minus your factory costs. Factory costs includes the fixed factory costs and variable factory costs. And then after that you get this figure. Then after that you minus your office cost, then you get net profit. But in the marginal costing basis, you take your turnover minus the variable cost, which includes variable factory cost and variable office cost. Then after that you minus your fixed cost, which includes fixed office cost and fixed factory cost. So this is the difference between marginal costing profit and loss account and absorption costing profit and loss account. Okay, we know that from the previous videos, we have gathered that, so in the stock, whether opening stock or closing stock, the stock will include the direct material, direct labor, and absorbed production overhead. You see, in the previous question that I've shown you, the stock would include an apportionment or an allocation. So-called the stock would also absorb the production overheads in using the absorption costing principles. Okay, the stock would absorb the production the production overheads into the stock. Okay. So, but in the marginal costing profit and loss account, the stock, you see here, variable cost, it means that all these here, I mean before coming to fixed cost, before contribution, all these things here is only variable cost. So your stock, your opening stock and your closing stock does not include fixed production overhead. You know, production overhead, you have fixed production overhead, like for example rental, and you will also have variable production overheads, right? So the stock does not include, because this is a caption, this is a heading for variable cost. So all these are strictly variable costs. So your stock does not include the fixed production overheads, does not include an allocation of fixed production overheads, but it includes an allocation of variable production overheads. But over here, using the absorption costing basis, your opening stock and closing stock includes production overhead. It includes fixed production overhead and it includes variable production overhead. Okay. So now we can read the rest of the question. Production is 15,000 units for 2004 and 7,000 in 2005. Sales is 12,000 and 9,000. The directors are concerned about how much lower profit in 2005 and ask you to investigate the causes. You ascertain the following information. The production overheads and selling expenses each comprises of a fixed and variable element. The variable element of production overheads varies with the number of units produced, and the variable element of selling expenses varies with the number of units sold. Okay, fixed element stays fixed. The selling expenses similarly involve both a fixed and variable element, which varies directly with the number of um, units sold. Okay, administrative expenses are fixed costs. So we know that administrative expenses is a fixed cost. So under fixed costs, okay, easy, administrative expenses we put first because we know the figure. Okay, so now they are saying that, what are they saying? They are saying that production overheads and selling expenses comprises a fixed and variable element. The variable element of production overheads varies with the number of units produced, and the fixed variable selling expenses varies with the number of units sold. Fixed elements stay fixed. Okay, so you see now here under fixed costs, administrative expenses, we put a number first. Then we put here fixed, because now from the question we know that there's fixed production overhead and fixed selling expenses. So we write here first. And then the figure we don't know, right? So we leave the figure blank. So whatever things that we can fill in, we fill in first. Okay. So now, and then why don't we do the easy things first? So under variable cost, we put opening stock. Opening stock, it should not include the fixed production overhead. So we leave the figure blank first. Then we have, oh, look at the question paper. You should have the question paper with you. Then we add direct material. Direct material is actually a variable cost. So just copy from the question. Then add direct labor, just copy from the question. Then production overheads. The question paper told us that there is a fixed production overhead and variable production overhead. So over here, we should only write variable production overhead. Okay, so we put here first. We don't know the figure, leave it first. Okay, then after that, you leave one line, then you less closing stock. Okay, here you should fill up the figures. Okay, less closing stock. Closing stock, it should exclude the fixed production overhead element. So we don't know the figure, we leave it blank. Then add variable selling expenses, because from the question it tells us that selling expenses includes a fixed element and variable element. So over here under variable cost, we should add variable selling expenses. We don't know the figure, so we leave this blank first. So we put total variable cost here, draw one line, and then we leave it blank. Then we'll come to contribution. So we get our structure ready. So then now we are going to do the workings to find out the difficult figures. So the production overheads. Okay, the production overheads. So I have so you see, in order to do my workings, I put here workings bracket W. Then this one will be W1. W1 refers to working one, because I will obtain the figure from W1. Okay, total production overhead for 2004 and 2005. So what is your total production overhead for 2004? Total actual production overhead for 2004. Okay, production overhead for 2004 will be 210, because this is the absorbed figure, and then it is over absorbed. So the actual total production overhead for 2004 will be 210 minus 35. So take your calculator, 210 minus 35. What you get? 175. And for 2005, what is the total production overhead? Total actual production overhead will be 98 plus 37. 98 plus 37 is 135. So this is the total production overhead for 2004 and 2005. So the number one, the note one of the question says the variable element of production overhead varies with the number of units produced. And the production units is given to us in the question. It is 15,000 for 2004, and 7,000 for 2005. Okay, and the fixed element stay fixed. So the production overhead, there is a fixed element and there's a variable element. The variable element varies directly with the production unit. So now can you see the similarity of this question and one of the previous question that I have explained to you before? So, this 175,000 consists of a fixed element and a variable element. And this 135,000 consists of a fixed element and a variable element. Okay, so that means if you imagined a linear a graph, okay, so that means even if the production is zero, there is a fixed production overhead figure which is fixed even if production is zero, right? So that is a fixed production overhead figure. So we have to think of a way to find out how much is the fixed production overhead figure. Okay, and as production increases, the variable production overhead will increase in direct proportion with production. Okay, so that means from 135,000, as it increased to 175,000, the difference is 40,000. So the production unit increases. So as the production unit increases by 8,000, the production overhead, the variable production overhead increases by 40,000, because fixed production overhead will not increase, it will stay fixed. Fixed production overhead is fixed. Even if production is zero, the fixed production overhead is a fixed figure. Okay, it won't increase. So when production increases by 8,000, okay, the variable production overhead increases by 40,000. 135 to 175 is 40,000. This is an increase by 40,000. So what is the variable production overhead? Variable production overhead will be $40,000. This is the variable production overhead. Divide by 8,000 units, okay, which is $5 per unit. So variable overhead for 2005 will be $5 times 7,000 units. Production is 7,000 units. So variable overhead will be 35,000. The ink is quite light here, so in the exam make sure you use a darker ink. Okay, then in 2004 the variable production overhead will be $5 times 15,000 will be 75,000. So 75,000 is variable. So how much is fixed? Fixed production overhead is 100,000. This is something like PSLE mathematics. So we are using our knowledge from those mathematics that we learned into this accounting paper. Okay, so similarly, 135,000, 35,000 is variable production overhead. So fixed production overhead is 100,000. So we have gotten our fixed production overhead figure. So we put it here, 100,000, 100. Okay, then our variable production overhead. That's why we should put the, okay, here I should put a bracket W1 because it reference to my working one. Then variable production overhead will be 75,000 in 2004 and 35 in 2005 respectively. These figures, okay, stock we haven't put in, okay. So then the question is also saying that selling expenses consists of a fixed selling expenses and variable selling expenses. So how much is the selling expenses? In the question, the selling expenses for 2004 is 108,000 and 2005 is 96,000. And selling expenses varies directly with number of units sold. So number of units sold is given. So using the same explanation, okay, you take the difference, then this one divide by this, you get $4. So 4 times 9, then it's the variable one will be 36,000. So then 96 minus 36, so 60,000 is the fixed selling expenses. So here same story. So fixed selling expenses is 60,000. So variable selling expenses, that's why I reference to W1, this working one, is 48,000 and 36,000. So we are putting in all the difficult figures one by one. So now we have to calculate the opening stock and closing stock. Okay, now look at the question. What are all the production costs? What are all the production costs according to the question here using absorption costing principle? So what are all the production costs? Can you take your calculator and then you add 150 plus 240 plus 210 is 600,000. Okay, so this production cost is 600,000. You see, the stock would absorb the overhead absorption rate. The opening stock and closing stock would absorb the overhead absorption rate, which includes the fixed overhead and variable overhead were absorbed. Okay, it will absorb. So you know that the overhead absorption rate is the estimated figure, the figure that we estimated at the beginning of the year. So it will absorb the overhead absorption rate. Okay, so the all these direct material, direct labor, and production overheads adds to 600,000, and in 2005 is 280,000. Okay, 200. You take 70 plus 112 plus 98 is 280,000. And the production unit, okay, all these figures are in thousands. The production unit is 15,000 for 2004 and 7,000 in 2005. Okay, so that means now you can know what is the value of 1 unit of your stock. Okay, so this is the production cost according to the absorption costing principle. Okay, this is the production cost. So the production cost includes the fixed production overhead. Okay, and the production unit is so much. So that means your stock value is 600 divided by 15 is $40 per unit. Okay, the value of the stock is $40 per unit. According to the absorption costing principle. Okay, in the question, how much is your opening stock according to the absorption costing principle? The opening stock is 200,000 and the closing stock is 320,000. So how many units is in the opening stock? How many units is in the opening stock? Okay, the opening stock is 200,000. So you take your calculator, 200,000, and per unit of the stock is the value is $40. So you 200,000 divided by 40 is 5,000. So there is 5,000 units of opening stocks in 2004, and closing stock is 320 divided by 40 is 8,000. Similarly, in 2005, the opening stock is 320 divided by 40, so there are 8,000 units of opening stock in 2005, okay, which is same as the closing stock. I mean closing stock in 2004 will be equal to opening stock in 2005. So the closing stock for 2005 consists of 240,000 units divided by 40. So there are 6,000 units of closing stock in 2005. So now we are going to value all these number of stocks, number of opening and closing stock for our marginal costing basis. So that means we should value all these stock value all these stocks so that it only incorporate the variable factory cost. Okay, so that the stock should only includes the variable factory cost, which and should not include the fixed production overhead. Okay, so valuing of stock, total variable production cost. So what is the variable production cost? What is the variable production cost? You take the direct material, so 2004 will be direct material, add direct labor, add variable production overhead. So can you take your calculator, 150 plus 240 plus 75, you get 465. So So 465 is our variable production cost for 2004, which is 150 plus 240 plus 75. So in 2005, the variable production cost will be 70 plus 112 plus 35, which is 217. Okay, this is the variable production cost. Okay, the total production unit is given in the question. It's 15,000 for 2004 and 7,000 for 2005. So the value of the stock per unit is 465 divided by 15 is 31. 2005, same thing, is 31. Okay, so then now we should value our opening stock and closing stock. So opening stock, this 31 is only consisting of the total variable production cost or total variable factory cost, okay, which excludes the fixed production overheads. So now we can value our opening stock for 2004. So you take 31 times opening stock is 5,000 unit times 5,000 will be 155 dollars, okay, and this one the closing stock will be 8,000 times 31. 8 times 31 will be $248. Similarly, in 2005, the opening stock will be 31 times 8 is 248, same as here. And the closing stock will be 6 times 31, which is 186. So now, we just fill in the figure. So closing stock, 248, put here. 186, put here. Then opening stock, 155 is from here. 248 is from here. So now we have do our workings and we have filled in all the difficult figures already. Okay, so then now we just total here, and then this will be a total variable cost. Then turnover minus total variable cost, you get contribution, and then contribution minus fixed cost, you will get the net profit, right? Okay, we have finished a very difficult part of the question. Then part B says reconcile the profit of 197 for 2004 with that of 47,000 for 2005. Reconcile means the boss is asking you as the accountant, hey, how come 2004 and 2005 got the profit is difference by so much? Can you explain to me? You know, the boss is telling you, can you explain to me? So you are trying to do a working, do up a working in a piece of paper in a neat and nice format so that you can explain to your boss comfortably. So that's why you do a reconciliation of profit for 2004 and 2005. So knowing the purpose of this thing, that would give you better idea how to answer the question. So the purpose of this is, for example, you are the accountant, you want to explain to your boss why the profit for 2004 and 2005 differ so much. Okay, so you see, then now I lay down my question. Okay, so this I can lay down my question. I put here $sign. Profit for 2004 is 197. So I leave a lot of space. Then at the end of the page, profit for 2005, 47,000. And in between all here, I want to so-called put all my explanation to reconcile 197 with 47,000. Okay. So you see, one of the reason that I can see in the question, you see, sales for 2004 is 12,000, and sales for 2005 is 9,000. So if you decrease in sales, of course your profit will decrease. So-called your contribution will decrease. So what is the contribution per unit? Okay, what is your contribution per unit? So this is sales. This is sales. So the selling price, actually I can derive the selling price. 840 minus 840 divide by 12,000 units. 12,000 units. So the selling price per unit appears to be 630. So in 2005, 630 divided by 9. So the selling price appears to be $70, and and the variable cost per unit is 31. So 70 minus 31 is 39. Okay, decrease in contribution based on less units sold. So that means we are basing on contribution. So how much is the contribution per unit sold? You take 420 divide by the sales figure divide by 12 is 35. So this one contribution per unit sold is 315 divide by sales unit of 9 is 35. So that means now I know that the contribution per unit sold is $35. Okay, so there are less. One of the reason why the profit decrease is because there are less units sold. So in 2005 in 2004 the unit sold is 12,000, and in 2005 the unit sold is only 9,000. So the decrease in contribution as a result of less units sold would reduce the profit of 2004 to 92,000. Okay, then what are other reasons why the 2005 figures is so much lesser when we have already minus out the lesser contribution because of a lesser unit sold? So you see, the thing is the profit and loss account produced in the question is based on absorption costing principle. Okay, and our marginal cost profit and loss account shows a lesser difference. Okay, so we have explained up to this part. Up to this part. So what other explanation that we can include? We can put it so as to explain why is it. So now we can look over here. You see, this is 2004 and this is 2005. Production overhead are over-absorbed, under-absorbed. And then this one we have a opening and closing stock figure. You see, over here all these fixed all this opening stock and closing stock includes the fixed production overhead. Right, so the closing stock figure includes the fixed production overhead, but in our marginal costing, the opening stock and closing stock does not include the fixed production overheads. Right. Okay, so actually this part B of the question only consists of 4 marks. Okay, so this one I am actually explaining to you in very detail. So actually you can put it in short. You see, if so that means all these you can maybe you can summarize in one line. 4 marks, 1, 2, 3, 4. Okay, you can summarize in one line. You can put here difference arising on on valuing of opening and closing stock using absorption costing basis, which includes fixed production overhead. Okay, so that you can get away with all these very complicated workings over here. But for your own purpose, for your own study purpose, you can actually analyze this in details. Because you see, if you look at the question, if you look at the question paper, okay, decrease in sales unit would cause a fall in contribution. But what other things have caused the fall in contribution? What other things have caused the fall in contribution? Because there is a fixed cost element of 2003 included in the opening stock of 2004. Because in the opening stock, it includes the fixed cost. Fixed cost is actually a period cost. You know, so if this 45,000, how you get 45,000? You get in the question paper, the opening stock value is 200,000. In our marginal costing answer, the opening stock for 2004 is 155,000. So the difference will be 45,000. So this fixed cost, you see, this fixed cost is included as a cost in 2004, when the fixed cost is actually a period cost. Don't you think so? You know, this 45,000 should not be included in 2004's cost, right? It should be in 2003 cost, because the fixed cost is something like the rental and all these things is a period cost. It's supposed to be 2003 cost. You know, it's supposed to be in 2003 cost, and now it is carried forward in the absorption costing profit and loss account to be included in the opening stock of the 2004. This 45,000 was included in the opening stock of 2004. So that means it was carried into 2004 cost, yeah, which is actually not fair. So that means now I'm explaining to my boss like this, right? There is the reason why the profit for 2005 is so low is one of the thing is because the cost is the fixed cost of 2003 is included in the opening stock for 2004. Okay, so then the closing stock so this one is a 2004's profit. So after minusing the contribution, which it will be 92,000. Okay, so then the fixed cost element that is included in the opening stock for 2004. Okay, for a fixed cost element of 2003 included in the opening stock, and then the closing stock figure also includes a fixed cost element. So in short, this one you can put it as what they call difference arising from valuing of opening and closing stock of 2004 and 2005, which includes the fixed cost, fixed production overheads into the stock. Okay. So now then we go to part C of the question. How many units need to be sold annually to break even? Okay, so total contribution. So in order to break even, your contribution must be equal to your total fixed cost. Okay, so your total fixed cost is 250,000. 250,000. Okay, so that means your contribution must exactly cover your total fixed cost in order for it to break even. So you know that just now I've told you that the contribution per unit is $35. You know, for example, 420,000 divide by the sales unit of 12,000 is $35. Okay. So your contribution, the total contribution in order to break even have to be 250,000, and your contribution per unit is $35. So number of units needed to be sold to break even will be 250,000 divided by 35, which is 7143. So that means to break even, you have to sell 7,143 units to break even annually. Okay, so then now D, I've explained briefly the advantages of marginal costing in decision making. So I explained to you already what is marginal costing. Okay, so now you have to explain. Okay, marginal costing separates the variable cost and fixed cost, which is important in deciding if the product is worth producing and determining of selling price or changes in selling price. Okay, so marginal costing is separates variable and fixed cost. So if it's a positive, fixed cost is fixed, you know, even if you don't produce, you still have to pay. So that means if the product is producing a positive contribution, then it's worth producing. Okay, and also determining selling price, because the or changes in selling price. The fixed cost for the whole factory is fixed. So your determination of a selling price should, or changes in selling price should largely, or more on changes in selling price should largely take into consideration the variable cost. Mhm. Marginal costing makes it easier to calculate the volume of production or break-even unit, like this one, break-even unit needed to generate sufficient contribution to cover the fixed cost. Yeah. So marginal costing easier to calculate the break-even. In the long term, for a business to be profitable, the total contribution must exceed the total fixed cost. So this is one of the way that I answer the question. Okay, so for students who wants to analyze all this slowly on your own, you can take a screenshot of this or copy down this one. Then you can slowly analyze the difference in opening and closing stock to get this figure. Okay, so since the question only give 4 marks, you can actually explain this in a one-line figure, like just now, like what I explained to you. Okay, so thank you for watching. Bye.